Morning, everybody, and thanks for coming out on a rainy afternoon. We never know what kind of a crowd we're going to get on a rainy day here in Washington. Plus, it's World Bank IMF week, but we're delighted to welcome Trinh Nguyen, who's a corporate economist at Natixis, which is a French corporate and investment bank. She's based out of Hong Kong, has a lot of experience with ASEAN economies in particular. But covers the region, as she did at HSBC before she was at Natixis. And she's also affiliated here at Carnegie with the Asia program as a non-resident. Trinh, you picked a good time to do this topic. There's a lot of interest. Part of it is the trade war. I keep trying to explain to everybody that economic structure in Asia has been changing for a while, not just because of the trade war. I spent a lot of my time looking at China. And if you go back as early as 2007, which was 12 years ago, I remember Wen Jiabao, who was then the Prime Minister of China, famously gave this press conference after a session of the National People's Congress where he referred to the Chinese economy as unbalanced, uncoordinated, unstable, and unsustainable. So even 12 years ago, Chinese leaders had reached the intellectual conclusion that something was amiss with the growth model and it needed to evolve towards something else. Part of that obviously involves an intention to move Chinese industry up the value chain. And as that happens, it creates opportunities for other economies around Asia. First, to bottom feed off of some of that, but also to benefit as they make their own industrial transitions. That's partly a function of policy. I talked to lots of business groups and CEO groups where people, particularly in the face of tariffs and the trade war, are looking for magic bullets as they do kind of a supply chain stack of different countries. And they say, will it be Bangladesh? Will it be Vietnam? Will it be India? Will it be Cambodia? Will it be Indonesia? Who's going to get the policy environment right? And I think for a lot of businesses and a lot of sectors, there's no magic bullet in any of these countries because the policy environment is not ideal really anywhere. India, to me, is a great example. Here's a country where Prime Minister Modi was just reelected really with a transformational political mandate. First government since the 1980s that's won a second term one-party majority. And yet, despite that political mandate, he has it at a time when the economy is slowing down and a lot of the data from India is not looking so good. And what's more, making big structural changes in India is always politically controversial. So if you think about something like manufacturing policy, this government has a big push, make in India, manufacture in India. But the last government, the second UPA government in India, also had a national manufacturing policy that, if I recall correctly, was designed to take manufacturing from 16 to 25% of GDP. And I think the share of manufacturing in Indian GDP actually shrank during that period because manufacturing, not just about manufacturing policy, it's about land acquisition and labor market flexibility and all these things that governments in India have found very difficult to do. So in that context, the trade war, but also structural and policy change in countries in Asia, we thought it would be a good time to have Trinh, since you're in town for the Bank Fund meeting, to come over and share your thinking about what's happening in the region. Trinh's terrific. She has very data-driven insights. She does it for clients through Natixis. And we're delighted to have her working with us at Carnegie as well. So with that, Trinh, we'll turn it over to you. Welcome to Carnegie and walk us through what you see happening in Asia. Thanks.
Thank you very much for having me here today. I'm Trinh Nguyen. I look at emerging Asia, and particularly, I would say one of my specialties is ability to have a comparative look at regional development, right? Not just looking at China, but North Asia, which includes South Korea, Japan, Taiwan, with ASEAN within it, and also looking at India and how do they view this in the landscape of a fast-moving environment. And today I will take you through three different angles. So we're going to first talk about what's happening economically in the region. Secondly, we're going to talk about how do we get here. And thirdly, what are the opportunities, arbitrage opportunities for the region? How do we move from here? So that is just how we're going to organize. Firstly, the title of the presentation is, Can Asia Benefit from the Trade War? We wrote a paper last year looking at the trade war and whether or not the rest of Asia can benefit from this substitution effect. And the reality and the conclusion we had was no. No one can win from the trade war in the short term. That is because the sheer size of China's manufacturing. I'll just give you a perspective. 1 out of 5 items in US dollar term comes out of China. That means China has 19% global market share. in manufacturing. If you take labor-intensive manufacturing, that's even more massive. What that means is that in the short term, if it cannot sell to the US, it can dump to the rest of the world, which essentially has happened, particularly in neighboring countries, which means it's further decompress the margins for neighbors, right? And that's essentially happened. So if you look at Asian growth, it has been decelerating. And when we talk about trade war and tariffs, you cannot talk about without talking about investment. Trade and investment go together, and even before the data that we see this year since December, the contraction of not just exports, but more worryingly, imports from the region, because we know that because of the supply chain, you need to import to export. The investment figure coming out of South Korea started contracting in the second quarter of 2018, right? And it has been contracting since into this year. And what is interesting about this is that it is not alone, and it was leading the region in its contraction. So you see a deceleration of investment everywhere. There's not a single country that hasn't seen a deceleration of investment. And obviously, we don't have this data for Vietnam because Vietnam doesn't release expenditure decomposition of GDP. It's very likely the investment is doing decently well there. But the point is that if you look at even current account deficit countries, countries that don't have much trade exposure, right? India is a country that's roughly almost $3 trillion. Its trade is very little, and its trade to China is 0% of GDP. But why is its investment decelerating? Why are imports contracting at double digits? What about the Philippines? The Philippines has been deglobalizing and deindustrializing for some time now, and imports are contracting. So across Asia, you see the import contraction, and you already saw that also with China's latest data this week. The imports contracted in US dollar terms by 8.5%. So this is a gloomy picture that we see across Asia, with the North Asians leading, particularly South Asia, especially because it is at the top of the supply chain with semiconductor. Now, what does that mean? That means that our conclusion that no one wins in the short term of trade war is true. It is true that it's very difficult to gain from trade war. Why? Because of these two factors I just mentioned to you. A, the US as an economy has a comparative advantage in in land and resources, in which many Asian economies cannot match. The only country in Asia that has oil and food surplus, trade surplus, truly is really Malaysia, to a smaller extent Indonesia, and obviously Brunei, which is very small. Most of the Asian countries look very similar to each other, particularly China, Korea, and Japan. They look quite similar in the composition. So what does that mean? Because of the tariffs have been primarily on Chinese manufacturing, right? The US imposition of the tariffs so far, the first 50, 200, and recently some on consumer goods are mostly on manufactured goods. Whereas the retaliation of China on the US is primarily on agriculture products and to some respect gas and oil, right? And all of these things, Asian countries cannot truly benefit from arbitraging in the short term. And you can see here what we decompose the trade war so far. So we just want to take you from the landscape of the key difference and I'm not going to talk too much about what this means for China, because it's not the center of this discussion. But truly, if you look at China's trade decomposition and by exports and imports, you can see that exports are mostly manufactured goods, where imports have more raw materials, particularly where it does not have a comparative advantage. And which is also the point we want to say, is that many Asian countries are very similar to China, particularly Southeast Asia and the North Koreans. They are similar in that they compete with China at a very different segment of the manufacturing ladder, right? At the lower end, in the labor intensive, it's the Vietnamese, it's the Indonesians that try to compete. At the higher end, it's South Korea, Taiwan. This is where China wants to go. It wants to be able to make in 2025 these higher end materials. And the result of this in the short term is quite difficult. So how did we get here? So before we talk about can Asia win or benefit from the trade war, we must talk about how did we get here. The really big moment was 2001, and many people forget that in 2001, before China joined the WTO, ASEAN's share of manufacturing export exceeded that of China's. And if you look at North Korea's, it was much bigger. And that moment...
South Korea.
I'm sorry?
You said North Korea.
North Asia.
Oh,
I meant to say North Asia. Sorry, it was.
Okay.
I don't know why I said that. But what's key is that when it joined, manufacturing moved not just from Southeast Asia, FDI moved not just ASEAN into China to arbitrage as labor and also incentives through benefits of regulation, but also Mexico, right? Let's not forget that prior to this, Mexico was a huge place where the U.S. had its electronic supply chain, and that got uprooted and moved to China as well. And so the key point here, the tectonic shifts that you see here, and I want to show you the transformation of the global economy, is that the share of China's global manufacturing has risen to almost 1/5 of the global economy. And that is not only in juxtaposition with the change in Asia, but also relative to that to places like Europe. And this is what's really key here. But what we're looking at is gross exports. And I want to show you the transformation in the supply chain of China and how that impacts the integration of a global supply chain in the world. So one of the key papers that we recently did was a global value chain. Basically, let me just explain what that means. That means that when you look at gross exports, there's a lot of that you don't see, right? For example, you import materials to create, you foreign inputs, and sometimes you then export some of your intermediates, then used by other countries to then use as inputs to then exports, right? The way we measure the global value chain is that you take out this foreign input component, because that is your country's participation in the global value chain, and you also take a look at the ability of that country to produce intermediates then use in another country to then export, which means that you're increasingly integrated via your domestic ability to export. And if you look at this, that China's now, in terms of its global participation in the value chain, is about 45% of its 2.2 trillion of export, gross exports. What does that mean? It means that if you look at the DVX, which is domestic value added in intermediates, has risen quite substantially. But that is also in juxtaposition with a trend that we see, which is that globalization peaked in 2008 and it has declined since, right? So how can that be that you have a country that is ability to rise in its value add, which is basically more vertically integrated and moving up the value ladder. Meanwhile, the process of global participation in value chain is declining, right? So that's the question that we ask in the research. And the reality is you look at what is driving this decline and look at the different regions. We want to show you what's very clearly here in this chart to juxtapose China and Germany is that China's ability to move up in the value chain is in clear juxtaposition to the decline of Germany in its ability to also export its inputs, right? And that's really what is really key as well in that you look at across in the region. In the value chain participation in the region is also quite interesting. If you look at if the global integration is declining, could that be because it's shortening the distance of the value chain? Not so much because we're not integrating, but we're more regionally integrating, right? That's the second question we ask. And when you dig down into the data, the reality is that regional integration is actually declining in Asia, right? It is declining, but then when you strip out China and you do an Asia X China, that it actually is rising marginally. And if you strip further the Asia ex-China into regions such as Southeast Asia, India, and North Asia, then we see that sub-regional integration is rising in Southeast Asia, rising very marginally in North Asia, and declining in South Asia. So the key conclusion we want to say here regarding the Asia region is this: China's ability to integrate itself vertically and move up the value chain has actually does not mean it's more integrated with the region itself, but What that means is that it must be more integrated elsewhere. And moreover, the trend that we see within the Asia region is that there's a trend of more integration within the Southeast Asia region. Now, I want to show you the third question we ask is that if globalization is de-globalizing, which means that we're no longer less participation, and is not due to the shortening of the supply chain regionally, then could it be sub-regionally, which we've answered, which is that no, with the exception of Southeast Asia and minorly North Asia, then is Asia more integrated with China over time, right? So if China is ability to move up the value chain, then is each of these countries participating more with China, right? And the answer is actually no for Asia, and only for Singapore, Vietnam, and Bangladesh. And actually, when you decompose and look at the picture, then it's very clear that many of these countries, what that means is that Vietnam imports more of these inputs from China as its arbitrage. And I'll explain that later when we think about this discussion. One of the things I also we don't really discuss, and which is not relevant to this discussion, is this question earlier, is that China's ability to move up the value chain through its ability to export intermediate goods, which are then used in other countries' exports, is actually quite interesting because we will not discuss, but its integration with Europe is more interesting, right? Within Asia, the integration with China is really in 3 countries: Bangladesh, Vietnam, and Singapore. Now, I mentioned earlier, the first point we asked the question, in the short term, can Asia benefit from the U.S. China Trade War? The answer is no. We know that a year later since the escalation. And I wanted to just show some data here on just the gross exports. We just showed you the value chain data, but I just want to show you the gross export. China has 19% manufacturing, but in terms of labor-intensive manufacturing, it's quite massive. It's all the way to 30%. And you look at the revealed comparative advantage, it's even bigger. And the countries that compete with China on that end is too small in scale, right? People talk about Vietnam being a winner of trade war, but Vietnam is a 90 million in terms of population versus 1.4 billion. So where does Vietnam want in the supply chain? It wants electronics, right? It wants textile. It wants a cleaner manufacturing. So that's what it's getting. It's setting up in northern Vietnam, this China plus one story. Now most of Samsung's phones are actually produced and export out of Vietnam. So, but not just Samsung, there's LG, many other Korean electronics in Japan, et cetera, et cetera. But Vietnam cannot capture every segment of manufacturing because it's too small. So it has to target, which means that if we were to avoid the crossfire trade war, and if you're a foreign direct investor and you want to arbitrage out of this higher wage costs, higher tariffs, and less favorable regulatory environment in China, where would you go, right? Who's opening the doors for you? What can you do? Can you really disrupt and move out of this vertically integrated picture where you have supplier skills and everything already set up for you, right? That's the key question that many people have to answer. And the one thing we have to also consider is that of this $2.2 trillion of gross exports to China export, roughly 40% of it is foreign invested. What that means is many of these companies go into China to then either produce, to ultimately export elsewhere, or to access these massively large markets. And that is potential for disruption in looking out. And so the second point I want to also highlight is that ASEAN and China, although the first glance it may look very different, they're very similar as well in terms of if you look at the comparative advantage they have, very labor rich, land somewhat, but in terms of labor to land ratio is very similar to that, very crowded, not a lot of arable land, with exception for some countries, such as Malaysia, with the exception of Indonesia. And Vietnam is also, land has gotten quite expensive recently. So this is one of the key areas, and when you look at this, it's not so easy to completely reshuffle everything and win. Now, we also take a look at how, in terms of in the US, whether or not these Southeast Asian and roughly India and a lot of the Asian countries can take away some of the market share from the US, and the answer is no. What is the largest export out of the US to China? Soybeans, right? Semiconductor. Some of this is pork. Now, does Vietnam have the scale to have massive land, agricultural land, to create soybeans? No, it has its comparative advantage. It's really cheap labor, and it's a location where it is. So as a result of this, the arbitrage is not so easy. I'm going to take a sip. And not to depress you too much, we're going to talk about opportunities. But let's not get too depressed. We published this paper last year that no short-term, but medium-term opportunities. Before we get excited and just start shouting out Vietnam when we talk about trade war, I want to just take a look, just take a step back as someone who looks at Southeast Asia, many of these countries, very closely, is that many of these countries have had these structural issues for a long time. Now, what happened after the GFC was that this flood of cheap liquidity that came to Asia because of this push thanks to low growth in the developed world and also lots of easy money, right, through easy monetary policy, not just the Fed, the ECB, the BOJ. As a result of that, there was a lot of what I would call lazy policy making. Structural reforms do not get done when you don't need to do it, right? Because there's a huge political cost when you shake the system. And as a result of that, many of these countries have a huge overhang when you have this Fed tapering tantrum, and more recently last year when the Fed raised interest rates by 100 basis points and started doing QT. The dollar liquidity situation severely affected current account deficit countries, and we're talking about countries like the Philippines, Indonesia, and India. Now, the key issue here is financing. In these countries, we know they're emerging. We know from this picture here, there are quite a few countries with very favorable working age population. What that means is that they need a lot of investment. But what kind of investment? The kind of investment that creates jobs, the kind of investment that is stable, and that is not volatile based on the whims of Jerome Powell or the change of the US business investment cycle. And that is not what's happening in Asia. So we think the policy solution for many of these Southeast Asian countries, plus India, is the same policy solution before trade war and after trade war, is that they need to work on improving their ability to compete better, to look more outward, and to start tackling some of these basically delay reforms that they haven't done, right? So simply in the Philippines, Indonesia, and India, really about land, labor reforms that needs to be done to really unshackle, but also on the capital market side, not just in portfolio investment, but direct investment as well. In the other countries that are already favorable to foreign direct investment, such as Vietnam, Thailand, and Malaysia, there are different sorts of reforms that are needed. There are more regarding skill level, right? If you really want to move up the value chain in Vietnam, you really need tertiary education needs to be there. It needs a different set of reforms altogether. And so when we look at here, you can see that Asia is complementary within itself. The story of aging China, the story of higher wage costs of China, and the story of U.S. China competing and everyone trying to get out of this crossfire, it's all the same story. It's just getting accelerated with the trade war, right? I'll give you an example. Korea started making the move out of China before the trade war. Japan as well. It started with geopolitics. Let's not forget that in 2014, there was a huge commotion over China and Japan. What happened is that as a result of that, there's diversification. So the geopolitical risk now, where people are thinking of a grander scheme through two major powers, but within the region, there are geopolitical risks as well. Before this, there was a THAAD incident with Korea and China, and as a result of this, there was a lot of tourism. But the diversification that we see is really a result of a lot of structural trends getting accelerated. So the key point is to say that the Asian region is very complementary with one another, where in North Asia, we have Japan leading the aging race and showing us what will happen, and where China is quickly following, but not just China, but also the likes of Singapore. We can see that we are not just looking at trade war arbitrage, but really a long-term structural story in Asia where the excess savings of a lot of these countries and also the slowing growth story will also have to be rechanneled within the rest of Asia as well. So where do we stand in terms of who can benefit from the trade war? This is a very simplistic look at wage costs. What we look here, we don't look at labor productivity, we don't see anything. You don't see other factors that investors think about when they open a factory, right? Investors have to look at the regulations, political risk. But what we see here is very clear. For manufacturing wages already in 2017, China has risen quite significantly relative to 2012. And what that means is that if you are very labor intensive, you have already begun that process, and we start seeing the data, and a lot of the FTs, foreign trade zones in China is already seeing that the interest to set up shop there has declined quite substantially. The manufacturing inflow into China shows that as well. It peaked in 2011, and it's declined by 20-something% by 2018. And within textile, that decline is sharper than 50%. However, there's an increase in manufacturing into China. It's in the higher end manufacturing. And where the inflows into China, if you look at FDI, is really on the financial services side, on the new story of China. The new story is that it's moving up the value chain, people are wanting more quality, and people are aging. And in that aging process, you want diversification and investment, you want a better hunt for your yield, so it's really the financial service story. On the other end, the old China story is the new story for the rest of Asia, which everyone is hoping is the story for India, right? And so here is a more holistic look at opportunities for Asia. So we just look at wage there, but what we did was we took a look at some input costs such as electricity and some of more soft indicators, right? Investors, when they invest in countries, they think about the business environment, the ability to enter, the exit, property rights, etc. Particularly with opening a factory, they tend to look at political risk. So we look at some of the rankings, and we did a study of what does that mean in terms of a relocation index within the region. And we found that for many of the regions of the countries, there are plenty of opportunities for relocation, with the exception of several, which is that the Philippines and Indonesia, essentially, particularly the Philippines, where it is nowhere to be seen in the story of how to benefit from the trade war. And you really haven't heard much about it. And that has to do with the fact that it continues to look more inward for sources of growth rather than outward. And when you do so, your ability to compete in the global marketplace is impeded, even though you get a more captive market, right, for your investors. But in the long term, that's not where you want to head. So finally, I'm going to end with this note, is that if you look at the history of not just Asia, but generally in terms of development story, it's actually, and this is something I did when I worked at the World Bank briefly for 2 years studying foreign direct investment. And what are different strategies of countries to foreign direct, right? So if you look at one of the successful stories people look at is Ireland, right? Ireland focused on use FDI for pharmaceuticals, etc., and it's able to capture that. And then there's a different story where in South Korea didn't really use FDI, but more through its own industrial fight. And then China, it's a bit of a mix between the Ireland and the South Korea model. But the reality is that to develop, you can't have this basically neoliberal Washington consensus approach where you just laissez-faire, let the market dictate. Because if the market dictate, you get nowhere essentially, right? You need some targeted liberalization. In economics, people tend to say that there are steps to liberalize an economy, right? You don't open your portfolio account first before your FDI account, for example, right? Look at Vietnam. The stock market cap is so small. It's the whole entire market is not, Apple is $1 trillion market cap. So if BlackRock or anyone wants to go into Vietnam, it can basically overflow and create crisis very easily. So the key point here is that it's very difficult to move up the value chain. And in this chart, I show you the decomposition of foreign value added and domestic value added intermediates used in other countries as exports. And you can see here is that Vietnam is still very low in DVX, which is the gray line. And what China has achieved is that it has grown, and it's doing so with a very, very forceful policy. And this is not a policy prescription for the rest of the region, but in order to grow and to move up the value chain, governments have to take a targeted approach of what they want to develop, what sector they want to attract, and use the policy to support that. A good example is the government of Vietnam decided that since it is a lot of labor, very unskilled, and we need people to just have sustainable labor, so therefore what it's going to do is decided on cleaner manufacturing, so to speak. So it takes two sectors that it thinks it can do well, and because it kind of does well in mathematics, but not necessarily in tertiary, but more in just fundamentally, it's just targeted electronics. So a lot of these countries will need to take that, and for Vietnam, it needs to take a much bigger step, because if it doesn't do more in developing tertiary education, it doesn't do more in textile beyond just assembling, to move into design, to move into creating the inputs, to move into creating the zipper, that in itself is a huge, right? There's a brand that China has eventually worked so hard to compete with this YKK zipper. So many of these little things that we don't think about as consumer products, these countries, when they think about developing, have to take these overt approach, without which we end up with the status quo. And that is a more likelihood of development path than were to have a more targeted policy. So that's the key conclusion that, not conclusion, but more of a thought. It's not a conclusion, because I just want to leave with, in terms of whether or not emerging Asia can benefit from the trade war. And I'm one of those people that's more of a cup half full, right? Recently, I've become kind of a huge hit in India, because I started tweeting about this tax reform that they did, where they cut 10% tax, and where the manufacturing tax rate is now on par with Singapore. And I think you probably have seen that. And they basically reversed some of this portfolio investment policy that they did that's very ill perceived by the market. But really, India would need to do much more, but it took that first step, and the market basically cheer it on, because it has the most expensive equity market essentially in the world. And despite of 5% growth, decelerating investment, et cetera, investors are betting it on, right? So here the message is that investors want these stories to succeed. They are betting on it because the valuations of Southeast Asia and India are much higher than if you look at, for example, Hang Seng Composite in Hong Kong, where PE ratios is about 10, or China, the Shanghai Composite. Valuations are quite depressed, right? Because investors are thinking this is the future. But the reality is that no matter how much cheerleading investors have for these economies, what they truly really need is more of a foreign direct investment to really have this sustainable funding, to really address these issues, so that every time the Fed says a hawkish word, you don't have an investment cycle decelerating, or a liquidity crisis that we have seen in Southeast Asia, and even much worse elsewhere, right? Like Latin America or Turkey, for example. So maybe I'll just stop there for Q&A.
Sure. So can I just ask, though, you're an economist,
Right.
but it sounded like a lot of what you were describing ultimately is about politics. It's essentially which countries have the political wherewithal to take structural decisions that are going to be difficult, politically fraught, painful for some constituencies. So I know you don't necessarily follow the political risk directly as much as the economics, but when you look at that and you say you're glass half full, are you glass half full because you think countries have the political wherewithal to do that, or are you just guessing that they will because they need to?
Well, actually, I started doing this quite an interesting time in 2011. So I may look young, but I'm not that young. No, well, I worked at the World Bank before, so some more workers. But essentially, I came when Vietnam had a huge crisis. So when the Philippines and Indonesia, all these countries were attracting portfolio investment, real estate prices were going up, everyone's partying like, I don't know, assets were just going up. Everyone was really happy in these emerging economies, right? So it's very hot, sorry. China was hot, everyone was hot. Vietnam was not. Its CPI was, I think it was like by August, I started my job August, it was like 23 or 24% year on year. The dong was depreciating. We had a governor that was like doing all kinds of weird things. And so the market had no confidence. And there was a huge question, was like, oh my God, what's going on with NPL ratios, right? And so many banks had conference calls with very limited data. And the only conclusion was that because we don't know what's going on, we're going to assume the worst. So no one was financing it, and it was a distress signal. So the question at the time was, we need to reform, right? And they asked me, what should we do with the banking system? So I started looking at what China did in the 90s, and I was like, okay, let me give you through my experience and how you should do this. But the reality is, when you go to the stress scenario, the question is, we need to reform. But what is the pace of reform we need to do? Because reform is very costly, right? You reform, but you have to reform at a certain pace, because if you reform too fast, you can risk destabilizing your economy, right? Because you can't change from A to B too quickly, but you still need to do it. So that's a key question. The second one is obviously political costs, and we see that already playing out in many. So when you look at, in my opinion, when you look at Asia, you look at who owns what. So the first thing I did was, like any economist, you look at, expenditure, production, your Excel sheet, you do all this. And then I have to actually look at who owns what, right? Because that really tells you what's going on with this economy. And it tells you ultimately who makes the decisions and when something goes on, etc. So good example is the Philippines. It looks like what you see, but reality is owned by a few families. It's very more inwardly. So when you have reform, so when a politician comes in and says he wants to reform, he has to have a buy-in of a certain circle, right? It's like when Jokowi comes in, he wants to reform. What does that mean? If you open up your economy, you liberalize it, which means that the domestic firms have to compete with external firms. So that is that's a political risk, right? So you have people resisting this change, and also you have your labor market resisting this change as well, right? Because your labor is not able to move about, but capital is more mobile, but labor isn't, especially in the lower end. So I think there's a huge risk, particularly in countries, and particularly if you look at the countries that haven't been managed to do this very well, is really the Philippines and Indonesia, where it's more difficult for it to take this step to liberalize due to the political economy of it. So Jokowi has managed to make some steps, and one of the things I would say is that if you look at his ambitious infrastructure plan, which everyone knows Indonesia needs to build, traffic is horrible in Jakarta, we need infrastructure. Now, he has a plan to build 40% of GDP in infrastructure, right? Fine, but he needs to finance it. How do you finance 40% of GDP in infrastructure? If your revenue ratio is like, tax revenue is 10%, and your expenditure is 15%, so adding non-revenue ratio, you roughly get about 12%, and you have a constitution mandated you can't exceed 3% deficit, right? But then you also don't liberalize your FDI, so what means you need your portfolio investors. What that means is just, the likes of these funds that go in and just do investment, and they can go out anytime. So it's very hard to do these long-term projects which have stable cash flows, but you need to do it when you build a road. It's not going to have this total return over time. So this is a huge question for Jokowi. And I think for me, looking at Indonesia, it's very difficult for Indonesia to take this leap unless it addresses the fundamental question, the financing side of it. And I think for all these countries, that needs to be the key. And when we go back to the Vietnam story, in 2011, it had that problem. It had a current account deficit, it had a fiscal deficit, and it didn't know how to plug this hole. And the only way it knew how to do it was to inflate its way out of it, and that's what it did, just double digits inflation. Now, ultimately, it realized that, the only way we can get out of this is that we need to attract money, sticky money. And we are going to do everything we can to get it, right? So Samsung, it went to Samsung and said, please come, and came. And, we're going to even build you a little, in the Hanoi airport, you have a little area where we give you land rights, we give you tax rights. And it did all these things. And as a result of that, it started getting investment. And this sticky FDI, now the banking system, liquidity has improved. The LDR, loan to deposit ratio, has improved so significantly that Vietnam, even though it's junk, it's actually so very, very junky in terms of sovereign rating. What that means is people say high yield, but it's below investment grade. But it funds cheaper than investment-rated countries like India, Indonesia, right? It funds somewhere about the 10-year in local currency is only about 4% something. To give you that perspective, it's very close to what China funds at the moment, which is a much higher rated, right? So liquidity matters. So what that means is that Vietnam can fund its deficit on its own. It issued a $1 billion debt in 2014. Investors kept asking, when are you going to issue again, right? It doesn't need to issue again. It doesn't have that problem. Its problem now is how to move up the value chain, right? You have all these arbitrage, people relocating, it's packaging. So is it going to be an issue where when China now has a problem with higher wages, it actually has productivity and moving up the value chain to make up for it? Because as firms move out, which they inevitably do, it has something left, right? Its ability to produce its own goods. When this happens to Vietnam, say 10 to 20 years later, is it going to be a Mexico story? Because when these electronics firms move out, it hollow out Mexico's electronics sector because it didn't take the ability to tap into this budget. And this is why I show this chart, is that to move up, you have to really, when you create this Samsung and you assemble, do you want to also create the packaging, get into these segments to start inserting yourself in this production process. And when you're able to do so, I think that's key, right? The ability to then organically have capability to produce goods that is demanded and is not exposed to the whims of investors, which ultimately will leave, if they come to you for cheap wages, they will leave when your wages rise. And that's inevitable in the development story. So that's why I have this chart.
All right, so let's give the audience a crack at you. And we have a mic that will go around. Questions, comments, objections. Yukon, let's just give you the mic.
Enjoyed that quite a bit. I have two questions.
Sure.
You had the wage chart.
Yeah.
And I've always been puzzled by this because wages in China have been increasing 2 to 3 times as much as other countries in Asia.
Right.
Okay? Despite growth slowdown and all these problems. So ultimately, when you talk about what countries benefit, I think people feel like they benefit if their salaries are going up.
Right.
So all these other East Asian countries, almost uniformly, the wages aren't going up, except for China's. Okay? And now people are speculating that China's going to come down. But as an economist, what it tells me is something sort of like strange. They're all linked by a production sharing network, which you just described. So for China's wages to continue rising much higher than other countries, it tells me that productivity increases in China are still continuing to be much greater, despite all the things going on. So one question I have is, why is this happening? Why is it the productivity increases in all the other East Asian countries haven't sort of like kept pace? One question. The second question I found at your chart about who's benefiting and what's happening, interesting because what you showed was that Bangladesh, Singapore, and Vietnam. What's interesting is that China runs trade deficits with every country in East Asia except for those three. Okay? And these three are quite strangely different. Singapore, Vietnam, Bangladesh, economically, structurally are so different. Yet they incur a huge trade deficit with China, whereas everybody in East Asia runs the opposite. And I never sort of quite understood what is it about Singapore, Vietnam, and Bangladesh that makes them different from the other dozen countries in East Asia.
Okay, so let me first address your first question. It is true that productivity has gone up, but it's also when you have wages higher like this, it's also input costs for firms, right? And it's not just wages, but also land prices have gone up. So if you go to a place close to where I live in Guangdong, it's very expensive to produce there now. It's not just wages, you have land, also tax benefits are not just there. So yes, when you have higher, just similar to the US, when you have higher wages, it's very good for the workers. But really, you also have to look at also relative to spending power. But at the same time, CPI has gone up. Real wages haven't gone up as much as nominal wages, right? Especially in urban centers, we consider the cost of housing. And therefore, I think that this is a double-edged sword, so to speak. Yes, it is positive, but it's negative from a labor cost comparative advantage, particularly in labor-intensive manufacturing, particularly when you consider input costs, right? Electricity, land, and labor, all those three. So if you're capital-intensive and you're on the higher-end skilled, you can still build a factory and just get rid of this labor cost input. And that's what people do, right? But not everything you can create a robot for, especially if your product changes too much. If you have a repetitive product, you can build a robot, right? Because it does this and does this all the time. But if you have a product that changes too often, then when you have a robot, then you have to make a new robot, right? It doesn't make sense to create a robot. So there's only some sectors where you can make it more capital intensive. So second. And I think the second issue for China is that there is a sense of costs risen too much, right? So you can see that CPI recently risen 3%, PPI is deflated. So there's a huge divergence in terms of the ability of firms, the profits margins are being squeezed.
Remember, the PPI going up, actually declining.
Yeah.
So the manufacturing costs are declining, but the consumer costs are going up largely by pork.
Right.
Only by pork.
Right.
But what I'm struck by is, despite all the rapid increases in weight, the cost of production in China actually haven't risen by as much adjusted as one would have expected.
Yes, in certain segments of the production chain, right? Yeah. So this is why if you look at FDI inflows into China, there's a certain segment that's rising.
Still rising.
Right? So this is what I stated earlier. In the textile and the labor intensive, it's declining very sharply. So if you're decomposing manufacturing inflow into China, it's minus 20-something% since 2011. But decompose it further, then you have two ends, right? Where you have textile declining very sharply, and on the higher end, it's rising. So as a net, it's declining. So the second question, and then the second thing, the second issue is that there's a generational impact, right? This rice bowl effect is no longer, it's true for younger generations. The millennials are facing a more difficult housing environment where the job opportunity is not as there as before, also in China. So there's a different, the development story is very different, right? We no longer have an essential shortage story that as you have in the 80s and 90s, but you have a different sort of inequality story in China. And so that's a distributional story. And the second question you have is Singapore and Bangladesh and Vietnam. So the story of Bangladesh and Vietnam is also related to your first question, is if you look at FDI inflows into China in textiles, it's collapsed by basically 50-something% since 2011. So that means that it went somewhere else, right? So new investment have gone to Bangladesh and Vietnam. Well, what do they do when they open up these factories? They still take the inputs from China, right? The cotton, the buttons, the zipper. So as a result of this, and then you can see here that for Vietnam, the DVX, right? The FVA for Vietnam is high, so foreign value added inputs. So it import quite a lot of components for production, and that's why you see Bangladesh and Vietnam. And why do you see Singapore? Because Singapore is a trade center. So what you look at Singapore trade is not a lot of it's domestic trade. You have to strip that out, and this data doesn't do that, right? So, for example, Singapore's trade as a share of GDP is massive, more than 100-something%. But if you look at the organic Singapore, non-oil, and none of that is only about roughly 50%. So Singapore, because of this, the China story is salient because it imports a lot of inputs, and then as a result of that, and that's why its integration with China is rising because of it's a facilitator of trade in the region as well. So it's a reflection of this reshuffling of the supply chain, so to speak, but still, even though segments of the supply chain has moved out, it's still, it's more integrated with China because it gets the inputs from China. So the question is, will Vietnam get this? It's a huge debate also, is that a lot of these, if it wants to do so, does it have the scale? Does it really want the pollution and all these things that come with it? If you want to produce fabric, for example, certain things are quite, and also do you have the scale? Should you move in that direction to create the intermediates? Or should you go from sewing and assembling these goods to go up to design or just different segment altogether? Whereas in China, it specializes everything, right? So what gets offshore is really the final end of it, essentially.
Yeah, please, let's give you a mic.
Thanks. John Goyer with the U.S. Chamber of Commerce. So we're not seeing a lot of new FDI going into Southeast Asia. That's what I'm hearing. But as a result of the trade war, are you seeing trends in terms of sourcing? So, for example, the likes of Walmart or Home Depot or Target, are you seeing them seek out new suppliers, utilize new suppliers in Indonesia or Malaysia or Thailand or other countries? So not new investment, but maybe utilizing existing capacity in some of those Southeast Asian markets, or maybe expanding some existing capacity short of actual new FDI. What are you seeing there?
Okay, so actually there's a lot going on. So there's two things. So actually quite a few factories have started to move to Vietnam in terms of on the electronic end. They've announced recently. And on the two countries, there are three countries that will benefit from this, really, essentially, is Vietnam, Thailand, and Malaysia. Thailand and Malaysia at a bit of a higher tech level than Vietnam. And then the reason many of the firms go to Vietnam is that it has this China plus one story, where it's very close to China, essentially, northern Vietnam and southern China. And Vietnam has an FTA with the EU, right? So no other country except for Singapore has it in Southeast Asia. And China doesn't have an FTA with the EU. So Vietnam does have this market access. So you do this for market access, for example. For Thailand, it's getting a lot of FDI inflows is rising, actually, the data. And a lot of people that need to source will try to look for it in Thailand, will try to relocate. The Thai government has announced a tax benefit package. And Malaysia has traditionally been a key intermediate in terms of electronics for the region. And now there's a sense of there's a resurgence. And recently, in the latest budget, the government has targeted electronic as a way to revive for Malaysia. So you do get some of that segment. But to make the point is that these countries are benefiting, but to really fully grab that, if you look at 40% of China's gross export is foreign invested, 40-something%, I don't remember the exact stats, 41 or something, is that really the only country that's comparable in size is really India, right? But India doesn't have that infrastructure yet. And if you look at the FDI into India so far, it's primarily for tap into India as a market in itself, right? So the likes of Apple, the likes of countries that tap into India as a large market, rather than India as an arbitrage to then use the cheap labor to then re-export elsewhere. So I think the story is primarily a Southeast Asia story so far, and the Indian government's trying to make it an Indian story, and I think it is gaining traction and more needs to be done. And if you look at the one area, if you want to look for from a U.S. side, is look at the ISM survey. In the ISM survey, there are two. One is manufacturing, one is services. Within that, they always talk about sectors contracting and et cetera, but they have anecdotes for every sector. And I've looked at this over the past several months, is that one key point is that their tariffs is a huge issue, and they're working on diversifying the supply chain. The question is, how do you do it, right? Due to the reasons I mentioned. But people are working actively to do it. And the longer the trade war lasts, and the longer people think, this back and forth, Trump said that she said, this back and forth of who said what, are we escalating, de-escalating? The reality is that it's escalating. Is that investors will need to arbitrage, and not just Americans, but Chinese investors, right? Already before trade war, there was a survey in Guangdong where people talk about manufacturing, and already before that, 40-something% wanted to relocate before trade war because the cost of production there is so massive. And now with the trade war and the tariffs, and one thing you have to remember is that 86% of China's trade is invoiced in dollar. What does that mean? When you have a depreciation of the renminbi, which is basically, let's say 10%, on the Chinese side, you have cheaper input costs, but as I mentioned, wages are still rising, so a 10% cheaper cost, but still offset by still input costs rising. So let's say you get 5-ish% cheaper, but then it's still priced in dollar, right? So what that means is that when you add a tariff to your dollar relative to last year and you want to remain competitive, you then need to pass on some of that input cost savings in dollar term. So there is still some margin compression on your end, right, to stay competitive. And that's what has happened is that they are passing on some of the savings. And on the U.S. side, the importer side, they haven't fully passed on to their American consumers yet. They absorb some of the costs. So if you look at the PPI on the U.S., it's risen, kind of plateau. Well, what that means is they're absorbing a lot of this cost, whereas CPI is low, right? It's 1.7-something%, right? It hasn't increased. So the key point is that everyone is looking for ways to arbitrage this margin compression, right? The margin compression is happening quite severely, and it's not just trade war also. There's a structural trend of consumer habits, right? Retail is getting hammered by the change of consumer habits, by the way people are becoming, the new millennials are more interested in services, etc. So there is a huge shift also for Asia, for many of these Asian countries that thinking about how to benefit from trade war. They have to think, well, do we try to attract last decades trends? How do we target FDI so we actually don't just get a sector that's already stale, right? If you look at the retail sector in the US, it's totally hammered. And it's not just in the US, but globally. So there's that question as well. The decline of FDI into China can be arbitraged some. But reality is that sector in itself is under stress, right? So there's a huge margin compression globally. And this is why to really benefit from the trade war, these emerging Asian economies will need to really wake up. And I think they're waking up so I think that's one of the positives of trade war, is that Indonesia is waking up. Jokowi, after seeing this World Bank report, which is basically so sobering, he then ordered his ministers to come up with a package in a month, right? Because up until that point, they were just thinking about iron ore. They wanted to move up the value chain of iron ore, so they banned the export of it so that they can get more smelting, right, to move up the value chain. So they weren't thinking about, we have almost 300 million people, how do we take advantage of this, et cetera, et cetera. So I think a lot of these countries are waking up, and I think the rise of China, in my opinion, is also positive for these countries in that it's put a lot of pressure on them, right? From a competition point of view, you move up, so if you grow so fast and we're so behind, you have to catch up, you have to grow. Staying stable is totally behind, right? Like for many of these countries. Not only that, you have competition from the goods coming to your economies, competing with your domestic firms. So if you don't shake them up, they will be hollowed out by the flood of goods, right? 1 out of 5 goods globally is coming out of China, manufactured goods. That's a lot.
Yeah. That World Bank report that came out, a couple of months ago? think.
Well, actually, it was
About a
just a
month ago.
presentation. They didn't. They actually like some press.
Yeah, I saw it written up in the Indonesian press. It was pretty negative.
Yeah, it's
Yeah.
quite negative.
Okay. Any other questions for Trent? Yes, please. Let's give you a microphone. Let's give you a microphone because, yeah.
I have to run.
Yeah, we're going to end up. We'll make this the last one.
Yeah.
Yeah, we got it. Okay.
The short answer is yes. So if you look at Vietnam, for example, what do? Like Vietnam is actually quite rural, right? The urbanization rate is not that high. So if you're just hanging around in the rural area, you do like very similar to many of these developing countries, right? You stand in a corner, you sell some goods, and you don't have a stable income, right? So when you have a firm like Samsung, and obviously it's not glamorous jobs for you, but for many of these people, it's stable employment, and you're relatively unskilled, and so you're able to go somewhere and have stable income. And that stable income allows you to then consume, to then make big purchases, to move up. So for a lot of these economies, the question is, would they, the ability to afford a better living from this, or whether or not the wages are not rising as fast, right? Is the cost of goods is the key question. But yeah, like for many of these countries, it is a positive. And obviously from this, there's negative externality when you have FDI. You hear a lot of this for areas where you don't gain from employment, but you have pollution, et cetera, et cetera. But generally speaking, it's an ability for a country with a large population that's relatively unskilled to provide jobs. A good example is India. Most of the population is informal. That's like, I don't remember the exact, it's 80-something%. Now, if you're able to put even 10% of this in a factory, they will have stable employment. What do they do when they have stable employment? They go somewhere, they collect it, and they're able to have stable consumption and over time move up the consumption chain. So countries that think that they can leapfrog out of this and you can just go straight to services, and that's the Philippines, right? The Philippines was actually doing pretty well in the 50s and the 60s, and it decided to look at the U.S., how it moved from manufactured services in the U.S. is a developed economy, is now services. So let's just go there. Skip industrialization. So it started providing skilled labor in services, nurses, et cetera, but then there's no demand for this because the lower end doesn't have jobs, right? The productivity is very low. Agriculture sector is very low. There's no jobs for these people. And as a result, these higher-end skilled people and services have to leave the Philippines to provide services for countries that have industrialized, right? Like economies like Hong Kong, in the Saudis, and et cetera, et cetera. They have to go to the U.S. For nurses, et cetera, here that are high demand, or Singapore. So that story can only work for a certain segment. And today in the Philippines, you can make a couple $1,000 doing call centers, right? But your hours are off because you're doing it for the US. But reality is to really fully develop an entire economy, you have to provide jobs for a lot of your otherwise, you have a lot of people loitering around as well, right? That's an issue in India where you have so many people, that's 1.3 billion people, and by 2050, they're gonna have like 1.6, that's 300 million people, that's a lot of people. Now, if these people already, we have a huge issue of people loitering, and men, there's a lot of energy, a lot of testosterone, and you're not channeling that to productive energy, you're going to look for trouble, right? And now, adding to that, in the future, you're going to have more of these people. And that's a lot of problems. So we can see that huge developmental problem as well. If you don't give these people to occupy them, to keep them busy, and to demand goods for the economy, et cetera, et cetera. So yes, the answer is yes. And frankly speaking, I've heard this before. A lot of people comment on my Twitter and also just in feedback to my research in general that, India doesn't need this. The future is India. But I say, yes, India needs it. It needs it because, yes, maybe the wealthier Indians, it can go to services, it can go to tech, it can go to software. But what about the rest of them? There are so many of them, right? You get as many jobs as you can in an economy, particularly for your low-skilled workers, because they're not mobile, they're not flexible, and they cannot do so much. And if they're the ones that you really need to look out for. And these jobs, and you may turn your nose at them, but they're very important in the development story. Without which, you're not going to be able to get people to move up in the durable goods, right? From basics to, durables, having a car, etc.
Okay, great. Well, Trinh, we know you're only here for one day from Hong Kong, so we're glad we got you on stage at Carnegie.
Thank you so much.
Please join me thanking Trinh. Thanks.
So I have to run.